Hi everyone, Bowen from Enhanced Asset Management. Just back to run through a few updates that we've seen from portfolio companies over the past week or so, and those have been realestate.com, ResMed, and ZIP. So we'll start with REA Group, and they released their third quarter results last Friday. And what we saw in those results were an 11% increase in revenue for the quarter, and that was driven by, again, a 13% increase in their listing yield. So that's essentially the price that they charge the agents to list on the platform. And, despite volumes being relatively flat for the quarter, that 13% growth in the listing yield just shows the pricing power that the REA continued to possess. We saw operating costs only up 5% for the quarter, which therefore created some operational leverage, and we saw EBITDA up 16%. REA.com had record Australian audiences, which were 150 million monthly visits, and that was up 12% for the quarter. They maintain over 100 million more monthly visits than their closest competitor, which is referencing Domain, despite all the additional investment that they've had from CoStar in the US. REA Group lowered their cost guidance, which is therefore going to increase EBITDA forecasts for the FY26, given that the revenue guidance was unchanged. So the business continues to perform really well. And we've seen a little rebound in the share price since those March-April lows, up from sort of 150 to around 180 where we are today, up around 10% since we added to the position in April. So, that stock's starting to work really well, and we expect these fundamentals to continue to work for the business, and we expect a share price well over $200. So next up was ResMed, and again, they announced another great set of results with revenue up 11%, further gross margin expansion, and that resulted in net income up over 20% for the quarter. They continue to generate extremely strong free cash flow, $500 million for the quarter, and that's all used to fund dividends and the ongoing share buyback. They now hold over $1 billion of cash on the balance sheet, which continues to provide the business with extremely high levels of flexibility, and they have the ability to go out and purchase some more acquisitions if they want to, or retain the cash on the balance sheet, increase the share buyback, increase dividends, whatever they want to do. They have that flexibility. They retain their guidance for FY26, and with the share price performing the way it is, we see it as extremely undervalued, with our valuation well over $40 per share. So we spoke about it here. We've seen the significant re-rate of ResMed's share price, again, partly due to some currency convert FX rates that we've seen. The Aussie dollar's appreciated pretty significantly against the US dollar, but I feel like a large portion of this D-rate has been just broader healthcare sentiment. And, I've got up on screen here the performance of CSL and Cochlear alongside ResMed, two of our bigger healthcare companies, and actually CSL just downgraded yesterday, so that share price is going to look even worse. So look, you'll probably get some redemptions from healthcare ETFs, given the way that the two biggest healthcare companies in Australia are performing, and that's going to weigh down on ResMed as well. But look, with the share price down under $30, we think this one's a great opportunity. Finally, we had ZIP with a trading update for April. They released their third quarter results just last month, so just one more month of performance that they updated the market with, and throughout April, it was really strong as well. So they had their TTV growth of over 40% in April again, and they're making good progress on their bad debts, continuing to trend downwards towards their guidance. So they retain their EBITDA guidance, and it just kind of gives the market a little bit more confidence in the full year guidance numbers. And again, this one is performing really well off the March-April lows. Again, a valuation of well over $3 on this one, and we expect that the way management is performing and the way that they have that flexibility to manage their bad debts and their TTV growth, it should have some good upside from here. And management knows what the market wants to see, and that's lower bad debts and maintaining that TTV growth. So I think that they're in a good position to balance that moving forward, and we expect to see some good share price performance over the next few quarters from ZIP. So in summary, we continue to see some positive updates from portfolio companies. Again, a lot of the companies that we're reading announcements from, they're increasing their forecast, they're upgrading. We're not seeing any downgrades come through. But the ongoing conflict in the Middle East is holding oil prices high, which is, again, continuing to place upwards pressure on inflation in Australia. Higher inflation and obviously higher interest rate forecasts keep bond yields elevated, which is obviously placing some downward pressure on growth businesses, which is the area of the market that we like to invest in. The key thing here is that earnings are continuing to outperform our expectations and the market's expectations. So if we do see some downward revisions to inflation and interest rates, or if we see the war in the Middle East come to an end, we expect these positions that have updated the market and are upgrading their forecasts will perform extremely strongly. So it might just be a little bit of a waiting game, waiting for macro conditions to normalize a little bit, and as long as the earnings are still in place, which they are, these stocks will perform really well. As always, this is general information only. If you do require any further financial advice, please reach out to your licensed advisor. Thank you all for listening.